Chipotle has been one of the best performing stocks on the market over the past decade. Shares are up 451% in just the last 10 years. And if you go back to when they came public, up 6,900%. Just incredible returns for Chipotle. The question now for investors is this stock still a buy? Because a lot of the tailwinds that Chipotle has been riding for the last few years may not look quite the same in the next few years. I want to get to exactly what I mean by that, because a lot of it has to do with the stock price, not necessarily the business itself. But let's dig into that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. And please subscribe on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First of all, let's look at Chipotle's performance over the past few years. The first chart I'm going to show is revenue. That's the reddish column there, grown at 10% compound annual growth rate over the past 10 years. Free cash flow grown a little bit quicker at about a 13% compound annual growth rate. Those are on different axes on the right, so I just want to point that out, that free cash flow is not exceeding revenue. So the business has performed extremely well. And what has driven that? Well, there are two things that are going to drive a restaurant's growth. One is going to be the number of restaurants. That's the line that you see there, compound annual growth rate of 8%. The other thing is going to be the revenue per restaurant. That's actually grown much more slowly, 3% compound annual growth rate. And you see there's that dip. That was related to the E. coli outbreak that happened in a couple of Chipotle locations. Actually really hurt their sales for a few years, but had a nice recovery and is now up pretty significantly from a little over a decade ago. So these numbers look really good. And Chipotle is obviously a very good business, very profitable to run each one of these stores, very busy stores. But this doesn't really explain the stock price movement that we've seen over the past decade or so. And so I want to dig into exactly why the stock has done so well. And these numbers are kind of shocking. This is a look at the price to sales multiple. That's the reddish line, and the price to earnings multiple for Chipotle. Now, the price to sales multiple has a compound annual growth rate. This is just the multiple, not actually sales, but the multiple itself has a compound annual growth rate of 5% on a PE basis. The compound annual growth rate over the last decade is 3%. Either way you look at it, multiple expansion has played a huge role in Chipotle's stock returns. The question for investors right now is that multiple expansion going to continue? Or are you going to be buying a company that's maybe going to be experiencing multiple compression, and now you have to generate higher sales and higher earnings through actually operating those stores a little bit better, expanding the number of stores, expanding the earnings that are coming from each of those stores? That's going to be a little bit less compelling because that growth rate is probably a little less than 10%. And so this is ultimately, I think, the worry for Chipotle investors today, because a price to earnings multiple of about 66, a price to sales multiple of 8.3, that's an insanely high price to be paying for a restaurant company that's growing revenue in the high single digits. So can they grow that quickly? It's possible, but it's probably not likely. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The huge concern for Chipotle investors is simply that the company's not going to live up to that kind of valuation. That's the kind of tech valuation you usually get from companies that are growing revenue at 20-30% per year, that are able to expand margins, that have a much bigger addressable market than you're going to get with something like Chipotle. It's just not possible for Chipotle to grow faster than about that high single digit range. But what if there was a better stock out there that was cheaper and actually growing faster? And that's what I want to highlight next. This company is called Portillo's. The restaurants that Portillo's builds generate in excess of $8 million per restaurant. Chipotle, that's only about $3 million. And their restaurant level EBITDA, so proxy for the cash flow that's coming from each of those restaurants, is about $2 million. They're expecting to increase their restaurant count 12 to 15% per year. So their revenue growth over the next decade or so should be in excess of 12 to 15% per year, because you're going to get a little bit of same-store sales growth on top of that. It's not out of the realm of possibilities that this company is going to grow 15 to 20% per year on a compound annual growth rate for the next decade or so. So this is the kind of numbers Chipotle had in 2007, 2008. And the valuation is incredibly compelling. Just take a look at this chart. This is showing revenue going back to 2019 with a compound annual growth rate of about 9%. So pretty similar to what Chipotle has. But what they've done over the last 2 years or so is really increase the number of stores that they're planning to open. So they're going to open, I think it's 8 or 9 stores this year, and they only have about 85 stores. But look at this price to sales multiple. Remember that multiple was over 8 for Chipotle. For Portillo's, it's only 0.9. So a much, much more reasonable multiple to pay for investors. And I think you're actually getting a much more compelling business. You have more potential revenue growth, more earnings growth, more ability to expand the store count. All of these things are the kind of tailwinds that you want, because you want multiple expansion to be a tailwind. You don't want multiples to be a headwind with your investment. And that's, I think, the ultimate worry with Chipotle, is that the company's just not going to be able to live up to that multiple. So even if they grow, let's say 8, 9, 10% over the next decade, if that multiple compresses significantly, the stock may go nowhere for the next 10 years, even if the business itself gets better. This is why what you pay for stocks is so important. So Portillo's is on the other end of that spectrum. You're paying a pretty reasonable price for the stock, and we have a lot of tailwind with revenue growth. This is a company that's operating most of its stores in the Chicago area, just started to expand in the Sun Belt, built a few stores in Texas. Those have done extremely well, Arizona, Florida, but they're nowhere near critical mass in any one of the individual cities outside of the Chicago area. So this is a long tailwind of growth. They have said that they could grow their store count by up to 10x, and that number keeps expanding. They keep growing that as they adjust what these stores look like and what their addressable market looks like. So I think if you're looking at restaurant stocks, Chipotle is one that I would not be buying today because it's just too expensive. I think it's actually better to be looking at selling Chipotle today and moving that money into a stock like Portillo's, trading for a very reasonable valuation. Revenue and adjusted EBITDA growth is going to be very consistent over the next few years. And by the way, you get a cult following. This is one of the things that's been really interesting covering this stock, is that everybody who knows Portillo's seems to have a story about Portillo's. And that's kind of the way that Chipotle was back in the 2004, 2005 range, back when I first experienced it in college. It was the cool place to go. And now it's just kind of everywhere. And that has been extremely good for investors over those past 2 decades. But that's not the kind of stock you want to pay a big multiple for. So I think a better option is Portillo's. If you're familiar with Portillo's or have a Portillo's story, please leave that in the comment section below, because I think this is one of those companies that more people need to understand and actually see how passionate people are about Portillo's, because that ultimately, that cult following is ultimately what drives revenue, earnings, and eventually a rising stock price. So let me know your thoughts in the comment section below. Don't forget to subscribe to Ace Magic Investing. Thanks for watching, everybody. See you here next time.